Good evening, everyone. Time for another silver update. This is a 10-minute chart of silver provided by netdania.com. You can click on the link below. And you can see we got a little bounce, a little pop here about 8:30 when the unemployment report came out. It was weaker than expected as far as one number, and then the rate was decreasing another number. This type of stuff, and we'll talk about it in a bit about the unemployment. But those types of numbers you really can't make anything from because really the government is cooking the books on so many things. It's just not even worth relying on. But just as far as the reaction goes, I guess you would say that the jump here may be based upon, if it is related to the economic news, based upon speculation of a potential QE or something like that. Not something that you would expect to impact silver seriously. How many people are sitting and watching economic numbers and then going in and buying silver? So I don't put a lot of stock in these movements based on economic numbers because I think it's probably people just pulling levers trying to make things jump one way or the other. But anyway, there was a decent price to stack this morning. 29.80 was what we got, and that's a pretty good price. If you can get around spot, you're getting around $30 an ounce for silver, and that's really a good deal. The big story as far as the charts go was crude oil. It wasn't really on a lot of news, and that's kind of a even stronger move. I think we need to pull out to about the 4-hour to see the size of that move. So that kind of rivals this rally that we had back in February, and we've given back now the vast bulk of that, and it takes us all the way back to the fall where we had this big rally from all the way from 75 up to 100. So we may be getting into that territory and start retesting that. We've got a couple of support lines, one here at about 95, I'd say, another one here at about 93. So probably would be a good thing for election year campaigning and things to have oil come down, have price of gas come down, have a nice driving summer without a lot of high prices for gas. So that very well could be the case, and it also may be pointing to further weakness in the economy. So we'll wait and see what oil does from here. I wanted to take you over to the question of the night, and that is on the forum, and it's from Fisting AG Physical, and the question is, why the Fed? Why the Fed? I was wondering about why we even have the Fed. It seems to me the government could print their own money without having to borrow it from anyone. I understand the whole theft by interest rate, but couldn't the government do the same thing cheaper? What's your opinion? So that's a very wide, open-ended question, so I'll just point out a few things. Traditional understanding of independent Federal Reserve banks is that they need to be independent so that they're independent from the government spending, because the big fear with politicians is that they're going to print up a whole bunch of money, give it to their constituents, buy elections, etc., be way too fast and loose with monetary policy, as politicians are always want to be loose monetarily. So the traditional argument is that you need to have this countervailing force, which would be an independent central bank, in this case the Fed. Now, do I believe that that's the real reason? No, I don't believe that. But that's the stated reason, and there actually have been some independent banks that have been fairly stable in the past. The Bundesbank for many, many years and there have been other well-respected central banks. So it's not a insane conception, but I certainly don't think it's one to be recommended. Now, the current Fed that we have, it doesn't really demonstrate any independence. It seems to be just falling in line with the money printing that the politicians want to be done, and it's funding that. So we certainly don't seem to have an independent central bank at this point in time. Now, as far as a perfect world scenario, I agree with you. Actually, I would take it one step further. I wouldn't have the Fed or any central bank. I also wouldn't have the government printing up its own money either. I would just simply have a free market for money out there, and ideally I would not allow the government to borrow any money at all. The government would have to fund its operations, its day-to-day operations, through tax revenues, and would be directly accountable for how it spent the money. And I think that you'd have much more responsible government if you had that. So going back to an older system of, say, a free-floating gold and silver exchange and then independent banks, and something very close to what was envisioned by the framers of the Constitution and then the Coinage Act, I think it was 1792. So a very good system that we were handed, a system with no central bank and a system with gold and silver free floating against each other, and people and markets able to determine interest rates and the value of money. That's absolutely the best system. The Fed system is a system that allows them to get their fingers in the pie, and they get to control things, and they get to fund all kinds of things that wouldn't be funded if the people had to vote for politicians who openly espoused those things. So a very undesirable system, and one that I would like to see go away. Now I want to return to the big story of the day, which is the unemployment figures, and those figures are so obviously just garbage as far as the unemployment percentage and other ones. So I thought I'd go over to the St. Louis Fed and pull out some charts to show you one that I think is really important. Actually, I'm going to show you two that I think are really important if you want to really get a picture of what's going on. Now, I put in the search box the term participation because I was looking for labor force participation rates. You can see I actually got 50 returns on 3 pages, so over 100 returns, and you can see there's a whole bunch of different labor force participation rates calculated. Here's Sweden's labor force participation rate. You can see it took a big dip in the 90s. It's fairly stable right now. You want to keep an eye on this figure, key figure here. The countries are going as low as 57, 55%, as high as 68%. And again, that's the labor force participation rate. This is the number of people, the percentage of the people that are in the labor force. Now that's a figure, the reason I'm pulling it up is that's a figure that's very difficult for the government to cook and to set expectations and report a good number. So if we just pull up the basic one, the civilian participation rate, you can see that it has been increasing very steadily since early 1950. It had a couple of blips, but generally the trend is up from 59% of the people up to a high of 67%. And you can see starting in about 2000, we had a fall off in that recession and then a non-recovery. A small rally and then a drop into this recession that we just had, and a catastrophic collapse in this participation down to about 63.6%. So a really big move down on that, and that is a number that can't be fudged. That's the percentage of people that are actually working as opposed to the people that aren't. And so that's going to be a real key number. They have to turn that number around really to turn the unemployment situation around. The other number, I just happen to pull it up on the national debt clock because that's a handy dandy place where you can get a lot of these figures. But you can see there's the national debt, of course, debt per citizen. But over here on the right, you've got the revenues. So you've got U.S. federal tax revenues, you got the income tax, you got the payroll tax, you got the corporate tax. So you can see here that we're at about 2.25 trillion in U.S. federal tax revenues, and you can see we're over here on spending. We're spending about 3.576 trillion. So we're running this huge $1.327 trillion budget deficit. But back over to this federal tax revenue, you can see the number is falling. It's falling quite rapidly. If we go to the breakdowns as far as income tax, the income tax part is going up, but the payroll tax part is going down, and the corporate tax, that one's going down as well. So this is a real key number here. You can look at the payroll tax, and you would have to say if the employment situation is getting better, which it isn't, but if it were, we would expect to see this number turn positive, at least incrementing positively, and certainly the entire federal tax revenues, we'd expect to see those go up. They're not going up. So for the most part, the unemployment figures that the government gives are fraudulent at best, and extremely deceitful and deceptive at worst. So it's a really bad number, doesn't really mean anything, but it still has impact on the market. Seemed to have a very big impact on oil. If we look at gold, it had a small impact, so that seemed to have a safe haven. And then silver, we got a bounce. We got below 30 and we bounced up. So if we look at the MACD here, we seem to be crossing to the upside. We may be able to get a rally, but the trend channels are still firmly in place. We have this declining trend, and it's been going on for some time. We're going to need to get up through 31 at least to reverse this trend channel, and we'll need to cross over to the positive on this MACD. And we'll talk to you next time.